But if I'm giving my money to somebody that's pressed, I can feel that energy, that pressed energy, and that pressed energy is getting ready to jump and fall off of a cliff. What's up? My name is Jerron Tyler, founder of Posterity.ai, a business credit platform that teaches entrepreneurs not only how to fund themselves, but how to walk through underwriting themselves that they may go out and maximize their business funding. And today we're going to be talking about the credit pie. The credit pie is so key, talking specifically about the personal credit pie. So many entrepreneurs are trying to go out and get $50,000, $100,000, $200,000, but it all stems from the foundation of your personal credit pie. And so what we have here is we have your personal credit pie. Your personal credit pie is made up of 5 components that we're going to walk through very thoroughly today. This is how you get your credit score. This is how you get your credit strength. This is what banking institutions look at prior to giving you approval. And so the very first one that we're going to talk about today is payment history. As you guys can see, your payment history is made up of 35%. It's the largest aspect of your credit pie. And I have a couple of notes jotted down and listed here, but I'll go ahead and fast forward to one of them that is very key. When you have one late payment, your credit score will drop anywhere between 80 to 100 points. Let that sink in for a second. Just one late payment. It could have been an intentional late payment. It could have been an accidental late payment. Whatever type of late payment or whatever type of reason it was, your score will drop anywhere between 80 to 100 points. So if you were 800, you'll go to a 700. If you're 700, you will instantaneously overnight go to a 600. I have listed above, this is the biggest credit killer. This is my philosophy. Everybody may not agree with this, but with being an entrepreneur, managing finance, overseeing the finance of my company and other companies as well, it is better to go into a tad bit of debt than it is to garner a late payment. It's better. And I want to break down an example as to what I mean specifically when I say that. And so this example is going to be used with a line of credit. So I have a line of credit here. And let's just say I'm in business. This is for entrepreneurs. This is even for those who are managing personal finance as well. But right now, specifically for entrepreneurs, because you have the leverage, you have the power, you have the creativity to go out and make money at any moment of the day. So here we go. We have a line of credit. And let's just say, hypothetically, you have a $35,000 line of credit. You're in a situation right now where perhaps you need to pay your mortgage, you need to pay your car note, perhaps you need to pay your staff, perhaps you need to invest in, a new batch of marketing, perhaps you need to invest in more inventory. In this instance, if your bank account at this particular time is sitting on $5,000, but your expenses for that particular month overall are $8,000, then I would much rather pull from this line of credit that I have and go into a little more debt opposed to using my own money and saying, hey, I'm $3,000 short, so that's $3,000 less that I'm going to be able to pay for my necessary expenses. Again, going into greater debt to avoid the late payment. Why? I'm trying to avoid the late payment because I understand now that the late payment makes up 35% of my personal credit. You guys heard me say this and you'll hear me say it 1,000 times more. America does not run on Dunkin'. America runs on credit, capital, and assets. I also added an S on the end of that, which is sales. But you want to protect your credit. If you can protect your credit, it will cause you to be successful faster and longer. I always say, get as much credit as you can before you need it, because it's better to have it and not need it than to need it and not have it. I've seen so many business owners fall, stumble, and go completely out of business because they could not put their hands on credit. When you are talking about a late payments, again, affect your credit score anywhere between 80 to 100 points. But one thing that's key that everybody in America should know is that late payments have an impact on your personal credit for 24 months. So there's some individuals that will go out and try to dispute the late payments. That's okay. But I want you guys to know that if you got that late payment 20 months ago, 21 months ago, 22 months ago, if it's 22 months, then you just need to wait 2 more months for the impact to flee. The whole purpose is to execute on approval. We don't want to get caught up in vanity metrics. Yes, nobody wants to run around and say, man, I got a 500 credit score, I got a 497. Nobody wants to say that, but at the end of the day, the goal is to get the approval. The next one we have here are owed balances. You may have heard somebody else say utilization. This is something that makes up 30% of your personal credit score. So as you can see, right underneath your actual payment history, but your utilization makes up 30%. Now, when we go to utilization, I've heard so many people say, you want to keep it under 50%, you want to keep it under 40%, you want to keep it under 30%. Let me tell you, I would like to keep it at no percent, but if I had to keep it somewhere, I would rather keep it under 10%. And so what I want to do is I want to show you guys an example as to how you could spread your actual credit and your balances out should you have to go ahead and pull on credit. You are in a situation, hypothetically, where you have access to a $20,000 credit card, and then you have access to another $20,000 credit card. And let's just say we went on and we had another $20K. If you are not in the credit space, finance space, and you haven't been trained on it, then the average individual does not know about spreading balances apart that your credit score, or so that your credit score does not drop, all right? This has everything to do with utilization. So I'll give you an example. Now, if we come here and let's just say hypothetically, I had to go out and I needed to make a $20,000 purchase. And I say, hey, well, I got 80 grand. I got, 20, 40, 60, $80,000. However, man, I don't want to spread them out. I just want to go swipe this $20,000. Well, what then happens is your utilization skyrockets through the roof because it puts one of your credit cards above this 30% limit, or what I would like to say 10%, right? 20%, 30%. It puts you at 100% of the limit, which then pushes your credit score down to the ground. Now, what you want to do in this situation is you want to take that $20,000 and you want to spread it out, and you want to go 5,000, 5K, 5K, that's 15, and then you want to go another 5K. Now, you spent the same $20,000, but you just spent it differently. This is a saying that I've been saying, I've gotten revelation on it, that it's not about what you have, it's about knowing how to use what you have. You got 80 grand, but you spent 20 grand the wrong way. You got 80 grand, spend the 20 grand the right way, and spread $5,000 over 4 cards, and you will see the balancing out of your actual credit score. Another thing I want you guys to know is that credit card debt weighs differently than other credit products. And so some of our most popular products, which I'll write out here for you guys, number one, we have a mortgage. You also have a car, and then you also come here and let's say we took out I guess this is a check for a personal loan. These products weigh differently on your credit report because you took out a $80,000 car loan, and then you took out a $600,000 home loan, and then you took out a personal loan. These particular products are debt products that are continually being paid down. Obviously, no one or no creditor is expecting you, on average, is expecting you to go out and pay off a 30-year mortgage in 12 months. Nobody's expecting you to go out and pay off as a lot of finance companies are doing now, a 7-year automotive finance loan. Nobody's expecting you to pay off a 7-year loan in 7 months, right? It's that way for a reason. However, when you go and you get a credit card, that credit card may perhaps start out at a $30,000 limit, that is. You may spend $500, you make the payment. Then you go out and spend $2,000. You made a payment, the minimum payment. And then you may go out and spend $7,000, right? You also made a minimum payment. And so now you're in a situation right now where you're looking at $9,500, but let's just say after the minimum payments, you still owe a $9,000 balance. Well, this right here is dropping your score, which is one of the reasons why it's imperative that you understand which products that you're going with so that you can best balance out your credit score. Again, the more you balance out the score, the more opportunities that you're gonna have moving forward. The next one that we're gonna dive into is your credit history. I I say this all the time because my goal in obviously creating posterity and doing a lot of content where we break down the nitty-gritty, if you will, and we really break down the context of what we're doing. The goal is for you to be able to understand underwriting as if you were an underwriter. And so with that being said, I oftentimes ask clients, ask students, ask colleagues, if somebody were to come to you and they were to ask to borrow $50,000, I want to break down this scenario. So you have credit history is what we're talking about right now. We have two individuals. Let's say we have John and then we also have Jessica. Now, John and Jessica are both business owners and both of them have viable businesses. They have staff, they have marketing, they have product, they have revenue, etc. But they're going and they're trying to take out a loan. Now, they're going to take out a loan and both of them are looking to get $50,000. Now, John wants $50,000 and Jessica wants $50,000, but we have one issue here. The issue is John has borrowed $50,000 before, but he hasn't borrowed $50,000 and paid it back since 1997. Now, I am not saying that John is a bad guy. I'm not saying that John isn't trustworthy. I'm not saying that John doesn't have the means to pay it off. But what I am saying is that on paper, John has not shown that he has paid anybody back since 1997. Let me bring more clarity to that. I'm not saying that he went delinquent. I'm not saying that he defaulted on any loans. I'm saying that there is no paper trail of John paying anyone back since 1997. However, on the other hand, I come here to Miss Jessica, and Miss Jessica borrowed $25,000 from Navy Federal. She went and she also did a $5,000 loan from CQ Credit Union. She also did a $7,000 loan from Wells Fargo. Now, again, she hasn't even borrowed 50 grand before. John borrowed 50 grand, but John borrowed the 50 grand back in 1997. Jessica has more recent activity. She got a 25, she got a 5, she got a 7. So the banker is more adamant about lending to Jessica because Jessica has a better credit history. Another thing that can help somebody out with their credit history that I had jotted down as well is going to be trade lines. Now, trade lines are good if you have intentionality with the trade line. Most people, when add somebody to a trade line, they think that it's just going to boost their credit score. They don't have to do anything else from there. But no, it will boost your credit score. But more importantly than that, it gives you that person's strength. I'll give you guys another example. Let's say I come down here and you have me, Mr. Jerron Tyler. And Jerron Tyler also has J. Tyler Jr. So I have my son. And I have a $35,000 credit card. This credit card is absolutely pristine. It's flawless. There are no late payments. I barely ever even have a balance on it. And so, boom, I have a $35,000 limit. We have JT and we have JT Jr. What I would do is I would go and add him to my $35,000 card. And now he takes on all of my amazingly outstanding personal credit history from that card specifically. So he doesn't have to get his credit ran for it. He doesn't have to have a job. He doesn't have to be producing any income. I just go on the bank's website or I make a call to the institution and say, hey, I want to add this person. Now that again goes and it strengthens their history. Now, what does that do when my son wants to go apply for a loan? When he wants to go apply for a business line of credit or a credit card? He now has a $35,000 limit showing. And so banks operate by what's called comparables. Now they're saying, well, if this lending institution gave him $25,000 and they gave him $35,000 and he has another $35,000 card on here and then they have another $60,000 card, that bank says, well, we see that they can manage what they have. So because our friends at ABC Bank gave him this amount of money, we'll give them the same thing. But here's another place that people go wrong. And again, the undergirding, if you will, of this teaching or of these sessions is to lead us on the path to getting approved for business credit. And so one of the things that I see a lot is so many entrepreneurs try to start out and they try to go out and get approved for the $35,000 card or $41,000 card or the $60,000, and I always use example or abbreviation, the BLOC, the business line of credit. But it's difficult for anybody to go and approve you for numbers like this when your personal credit only has a $1,000 TJ Maxx card on it, or your personal credit only has a $500 secured credit card on it. It's like, we appreciate you. Thank thank you so much for paying your bills. Thank you so much for building those relationships. But unfortunately, that is not enough to get you to the place of getting approved for $50,000 limits. That banking institution would be unwise. That banking institution would be putting their funds at high risk and high jeopardy to get you that money. They don't even know if you can manage it, which leads to the next space, man. This gets me up to the next space. We'll jump here and then we'll go to new credit. So we're now talking about your credit mix. Your credit mix is so key. When bankers are looking at, or banking institutions are actually looking at your profile, they're not only looking at how you manage one product, they want to know how you manage the plethora of products. And so I actually already wrote it out here in another example. When you start talking about different credit products, but I'll draw out another example for you guys. So when you're talking about a credit mix is comprised of being able to evaluate how you've managed different products. And so the typical products we have, let's say we go with a home. Now this home can be interchangeable with an actual mortgage or a rental property or a place that you're renting, because they also have softwares. Softwares are also out now where you can connect your rental payment and rental history to report to your credit report, which is really smart. It's really wise. If you're already in a position where you're not actually building equity, taking advantage of tax benefits of actually owning a home, the least you could do is sign up for a subscription that would cause your rental history to report to your credit report, because it is a trade line, especially if you're paying on time. If you ain't paying on time, it don't even make no sense to do it. But if you're paying on time, then that is 100% what you should do. So we have here a house or an apartment. We also have our vehicle. We have a personal loan. We have a personal line of credit. Let's call it a PLOC. And then we also have a personal credit card. So we go through with some of these basic products. You have a house, you have a car, a personal credit card, a personal line of credit, and a personal loan. Now, once a bank sees that Mr. Jerron Tyler or Mr. Jeffrey Wilson or Miss Jessica Thomas has managed a plethora of products, they're now more confident. Their job is to evaluate you so that they can figure out one thing. Okay, you have CDFIs, you have companies out here that their mission is to reinfuse economics or reinfuse capital back into certain regions and communities. But at the end of the day, underwriters have one mission, and that mission is to evaluate you to a point where they say this person either can or cannot pay us back based on factual data, not by faith, not by happenstance, not by I wished upon a star. No, can this person pay us their money back? Can they pay us our money back? That is what a banker wants to know. When you start talking about credit mix, this is it. This one here is new credit. Now, there are two schools of thought here when you start talking about new credit. By definition, or by the, what's the word I'm looking for? By definition, legality, if you will, legal text, having new credit by way of definition is potentially putting you in a space where you can lower your credit because you're applying for too much new credit, all right? So you're in a situation, you've gotten your credit hit 1 trillion times, you got 25 hard inquiries, 30 hard inquiries, 50 hard inquiries, you're opening up all of these accounts, and that makes it hard for the institution to gauge and track where you are. They don't know if you're in distress, they don't know if you're panicking, they don't know if you get ready to go bankrupt, they don't know what's going on, and so they're looking at you opening up all of these accounts rapidly, and then what's happening is, as you're doing that, it's dropping your personal credit. Now, I'm going to give you my school of thought, because this is another thing that I've actually experienced from my experience, and that is not opening up new credit as often. Let me tell you what I mean by that. I had a real client when I was in the mortgage industry that did not, I use that example of 1997 because it was a real place. I had a lady, she did not use credit since 1997. She did not have financial issues. She had money in the bank. She had a savings. She had high yield savings account. She had money market account. She had money, but she just did not believe in credit until it was time to buy a house. Now, in that instance right there, we could not get her an approval through Freddie Mac fact, we could not get her an approval through a conventional loan, through an FHA loan, because she did not have any trade lines. And so I want to share that with you guys for those out there that may want to operate in all cash, right? I don't run into as many people that operate like that today. That was a very rare case, but that is a situation or another school of thought that I want you guys to keep in mind. Now, what my recommendation is that at the most optimal state, I would recommend somebody going out and applying for new credit every 2 years. This is for informational purposes only, based on what I've done, based on my experience, because inquiries drop off every 2 years. And so again, my philosophy is that I want to get as much credit as I can before I need it. I don't want the worst time to go and try to go get approved for a business credit card or business line of credit is when you need it, because newsflash, banks hate lending to people who need money. Oh my God, it sounds absolutely freaking ridiculous, but it's the truth. Banks hate lending to people that need money. That's like somebody coming to you, your mother, sister, your brother, a friend, a long lost cousin. They're coming to you and they're saying, hey, can you please give me $25,000? I need $25,000. Can you please give me $25,000? Opposed to somebody saying, hey, man, I have a project that I'm investing in. We already have 6 investors that have thrown up $25,000. Just wanted to know if you would like the opportunity to be a part of this amazing project that we have going on. It's a different tone, it's a different vibe, it's a different energy. But if I'm giving my money to somebody that's pressed, I can feel that energy, that pressed energy, and that pressed energy is getting ready to jump and fall off of a cliff, because you're operating on this last chance, second chance, third chance opportunity, and we're wishing upon a star hoping that it works. And so this right here, guys, is the credit high. Man, thank you guys for watching. I appreciate you guys. We got more videos on the way, more fire, more energy. I'm pumped up. I'm excited and ready to run all throughout the earth. But I'm telling you, if you found value in this video, like, share, subscribe, comment, share it with your business bestie, your best friend, your husband, your wife, your cousin, your sister, your brother. The people need the information, baby. I'll talk to y'all soon. Thanks for tapping in, man. I love y'all.